Today, we're looking at the top 10 states where foreclosures are exploding in 2025, and what that really means for homeowners heading into next year. You've probably noticed it already. More for sale signs, more houses sitting empty, and more stories about families falling behind. But this time, it's not about reckless lending like 2008. It's about the cost of living catching up. Higher mortgage rates, bigger tax bills, and insurance premiums that have doubled in some states. So before the headlines spin it, let's look at the data and the real stories behind it. Welcome to Estatescope, the channel where we expose the hidden forces shaping today's real estate markets. From climate risk to insurance pullouts to overlooked government policies, we break down what's really behind the headlines and what it means for your investments, your home, and your future. If you're into real estate with a twist of investigative reporting, hit like, tap subscribe, and ring the bell icon so you never miss a story that could impact where you live, what you buy, or how you build. Now, let's get into what might be one of the most overlooked real estate catastrophes of the decade. Nationally, the direction is clear. In the first half of 2025, the U.S. recorded 187,659 foreclosure filings, 5.8% higher than the same period last year. ATTOM's October update shows foreclosure starts up 16% year over year, and completed repossessions, actual bank takebacks, up 19%. The average time to complete a foreclosure now sits at 608 days, down 25% from 2024. Lenders aren't waiting around anymore. Mortgage rates above 7%, property tax reassessments, and insurance premiums climbing 30 to 60% in coastal states have erased the breathing room many households once had. And though delinquency rates remain below the 2008 peak, the slope of change, how fast those numbers are climbing, is what experts are watching. Number 10. Texas. Texas, usually the symbol of opportunity, starts our countdown. According to ATTOM's latest housing report, roughly 1 in every 3,300 homes in Texas faced foreclosure during the third quarter of 2025. That's one of the highest totals in the country, with about 9,700 new filings just this quarter alone. It's not a housing bubble. It's the slow squeeze of costs catching up. Property tax assessments jumped around 11% statewide this year, and average home insurance premiums have climbed 35% since 2023. Add in record-breaking heat and spiking energy bills, and even stable households are stretched thin. Dallas and Houston together account for nearly half of the state's foreclosure filings, according to the Texas Real Estate Research Center. They've also seen 90-day delinquencies rise by roughly 14% since spring, a clear sign that families are struggling long before they ever miss a mortgage payment. For most homeowners here, it isn't overspending or risky loans. It's inflation slowly eating away at every dollar of breathing room. Number 9. Iowa. Next is Iowa. Steady, quiet, and suddenly vulnerable. ATTOM's latest foreclosure report shows filings here have crept up again this year, marking one of the sharpest increases in the Midwest. It's not a wave, but it's the fastest pace Iowa has seen since before the pandemic. The reasons sound small on their own: factory hours being cut back, rising costs for farm supplies, and another expensive winter ahead as heating bills climb. But together, they're tightening the budget for working families across the state. Local banks say late payments are becoming more common, especially in areas like Des Moines and Cedar Rapids, where property taxes have continued to edge higher even as home values have started to level off. For many Iowans, the pressure isn't from overborrowing. It's from a cost of living that simply isn't lining up with their paychecks anymore. Number 8. Ohio. Ohio ranks number 8 with 1 in 3,114 homes in some stage of foreclosure. Cleveland and Toledo are both up 25% year over year. CoreLogic's October survey found that 60% of the state's at-risk mortgages belong to homes under $200,000. the exact segment hit hardest by rising utilities and maintenance. Mortgage counselor Renee Harris told the Akron Beacon Journal, "It's not about people buying too much house anymore. It's about people whose bills outgrew their paychecks." Number 7. Utah. Utah, the darling of the pandemic housing boom, is now in correction mode. Home prices climbed 61% from 2019 to 2023. Now, ATTOM shows filings up 22% in 2025. 1 in 4 Salt Lake City homeowners has an adjustable rate mortgage, most resetting above 7%. HOA fees for new subdivisions are up 30% since 2022. And water surcharges after this year's drought added new monthly costs. Economists call it a soft landing that doesn't feel soft. Number 6. Illinois. Illinois holds number 6 with 1 in about 2,880 homes in foreclosure. Cook County logged 4,200 filings in Q3. Property tax burden, 2.23% of assessed value, the highest in the nation. Population decline of nearly 100,000 residents since 2020. And limited job growth mean fewer buyers and more underwater owners. In Chicago's South Side, block-level data show filings up 40% from a year ago. A reminder that regional trends hit hardest in neighborhoods already stretched thin. Number 5. South Carolina. South Carolina takes the number 5 spot, and it's not hard to see why. According to ATTOM's latest foreclosure report, about 1 in every 870 homes in the state received a foreclosure notice, one of the highest rates in the Southeast. Charleston County filings rose nearly 30% this year, while Horry County, home to Myrtle Beach, saw a similar jump. These are areas that thrived during the pandemic housing boom, when remote workers and investors flooded the coast looking for affordability and sunshine. But the wave that lifted prices is now pulling back. Insurance premiums in coastal zip codes have nearly doubled since 2022, and some homeowners are paying more for insurance than for property taxes. In flood-prone areas, major carriers have pulled out entirely, forcing owners into high-risk pools with skyrocketing costs. Local property managers report a steady rise in short-term rental listings as small investors try to cash out before rates climb again. In parts of Myrtle Beach, condo listings are up more than 40% compared to last year, and many are being sold at losses. Economists warn that South Carolina's once booming relocation markets are reaching a turning point. The same migration that drove up prices is now reversing as costs catch up to wages. Or, as one local analyst put it, the boom towns are turning back into break-even towns. Number 4. Indiana. Indiana comes in at number 4. A state that often flies under the radar when it comes to housing struggles, but right now, it's quietly feeling the pressure. ATTOM's latest report shows roughly 1 in every 2,700 homes in Indiana faced a foreclosure filing this quarter, about 21% higher than last year. It's not one big crisis causing it. It's the accumulation of smaller ones. In manufacturing-heavy cities like Evansville and Fort Wayne, shorter shifts and temporary layoffs have cut into household income. When overtime hours disappear, so does the safety margin that kept many families current on their loans. Meanwhile, property insurance premiums have risen nearly 15% since 2023, and average energy costs are up as much as 20% in colder months. For a working family already balancing tight budgets, that's enough to tip from stability into strain. According to recent Federal Reserve data, nearly 4 in 10 Indiana homeowners now spend more than 30% of their income on housing, what economists call cost-burdened. Mortgage advisors in Indianapolis and South Bend say more clients are coming in not to refinance, but to ask how to downsize before it's too late. It's not about reckless borrowing or risky loans here. It's about wages that haven't kept up with inflation, and a housing market that's starting to price out the very people who built it. In Indiana, the story isn't sudden collapse. It's quiet exhaustion. Number 3. Nevada. Nevada's roller coaster continues. And this year, the drop is starting to feel real. ATTOM's October report ranks Nevada among the hardest hit states in the country, with roughly 1 in every 830 homes receiving a foreclosure filing this quarter, a 27% increase from last year. For a state that lives and breathes real estate cycles, this one looks familiar, but the drivers are different. In 2021 and 2022, Las Vegas became a magnet for remote workers and investors. Entire neighborhoods were bought up by out-of-state buyers turning homes into short-term rentals and quick flips. But in 2025, that wave is receding fast. New licensing laws for vacation rentals have cut profit margins, and insurance premiums in Clark County have soared by more than 40% in just 2 years. Even well-managed rentals are seeing occupancy rates drop nearly 12% this year as tourism cools and nightly rates fall. Local agents say listings have jumped more than 35% year over year, and many are labeled distressed or pre-foreclosure. For homeowners who bought at peak prices, refinancing isn't an option anymore. Rising interest rates have locked them in place. Outside Las Vegas, smaller cities like Henderson and North Las Vegas are seeing investors quietly exit, leaving properties sitting vacant longer and pulling average home values down with them. It's a reminder of how quickly confidence can shift in a state built on risk and reward. The same investor energy that made Nevada one of the post-pandemic housing hotspots is now fueling its downturn. Only this time, it's not the gamblers losing their luck. It's the hometown. Number 2, Delaware. Delaware might be one of the smallest states on the map, but its foreclosure numbers are ringing the loudest alarms right now. According to ATTOM's latest October report, about 1 in every 830 homes in Delaware received a foreclosure filing this quarter, giving it one of the highest foreclosure rates in the country. Earlier this year, Delaware briefly led the nation, with roughly 1 in every 1,800 homes in distress. And instead of slowing down since then, the trend has only accelerated. Filings in Wilmington and Dover are both up around 30% since summer, and the state's overall mortgage delinquency rate has climbed nearly 40% higher than it was this time last year. But Delaware's housing stress isn't caused by falling prices or risky lending. It's driven by cost creep. Condo associations have raised maintenance assessments to cover flood mitigation upgrades. New stormwater fees, required by updated coastal regulations, are adding hundreds of dollars to annual bills. Even modest single-family homeowners are now paying more in mandatory local fees than they were for property taxes 5 years ago. Add in rising insurance premiums for flood-prone areas, and a slowdown in wage growth. And many families are now paying more each month just to own the same home. Economists at the University of Delaware say the problem is subtle but serious. When incomes barely move and fixed costs keep climbing, homeowners don't fall behind all at once. They slowly lose their footing. And that's exactly what's showing up in the data. For a small state, the numbers hit loud. Not because they're the biggest, but because there's nowhere to hide when the pressure builds. Number 1. Florida. The Sunshine State has always represented the dream. Sunshine, growth, and new beginnings. But in 2025, that dream is colliding with reality. According to ATTOM Data Solutions' October 2025 Foreclosure Market Report, 1 in every 814 homes in Florida entered foreclosure in the third quarter, the highest rate in the entire country. More than 28,000 new filings were logged between July and September, a total ATTOM describes as significantly higher than pre-pandemic levels. In Miami-Dade County, completed foreclosures are up 35% year over year, according to data cited by HousingWire and South Florida Business Journal. Insurance costs are one of the biggest drivers behind that surge. The Insurance Information Institute reports that the average homeowner's premium in Florida has risen 64% since 2020, making it the most expensive insurance market in the United States. Some insurers have left the state entirely after storms made coverage unprofitable, leaving homeowners with fewer choices and higher prices. Hurricanes Milton and Helene added billions in property losses and left thousands of families displaced. Many are still waiting on settlement payments or federal relief to begin rebuilding. Meanwhile, adjustable-rate mortgages that were signed during the low-rate boom of 2021 are now resetting above 7%, pushing monthly payments hundreds of dollars higher. For families already dealing with property tax hikes and rising insurance, it's becoming impossible to keep up. Governor Ron DeSantis recently addressed the situation, telling local reporters, "Florida's property insurance market has faced extraordinary pressure, but reforms are underway to stabilize it and protect homeowners from unaffordable premiums." Still, for thousands of homeowners, those reforms are coming too late. Real estate agents in Orlando and Tampa say they're seeing more so-called quiet listings, homes being prepped for sale before owners fall behind. Investors who rushed into Florida's housing boom in 2021 are now scaling back or selling off properties to limit losses. Even retirees who once came here for lower taxes are feeling the impact. In some coastal zip codes, insurance premiums now rival, or even exceed, mortgage payments. And yet, despite the turmoil, cranes still line the skylines of Miami, Fort Myers, and Jacksonville. Construction hasn't stopped. The demand for Florida living hasn't disappeared. The question is no longer whether Florida will rebuild, it always does, but who will be able to stay once it does. The state that once promised sunshine and security is now the storm center of America's foreclosure surge, caught between climate, cost, and the... What's happening in Florida isn't just a local story. It's a reflection of something bigger. Every state on this list, from Texas to Delaware, is telling a version of the same story. Costs rising faster than anyone can keep up. When you step back and look at these 10 states together, a clear pattern starts to emerge. It's not just about foreclosures, it's about pressure. Across the country, costs are rising faster than wages, and the safety margins that kept families afloat are disappearing. ATTOM's October 2025 report says it plainly. The U.S. housing market still looks healthy on paper, but beneath that surface, financial stress is building, quietly, steadily, and everywhere at once. In places like Florida and South Carolina, it's insurance premiums that have doubled in just a few years. In the Midwest, it's property taxes and energy bills that have climbed faster than paychecks. And out west, in states like Utah and Nevada, it's rising mortgage rates and investor pullbacks that are leaving entire neighborhoods in limbo. The pattern is the same. The numbers just change zip codes. Homeowners who stretched to buy when rates were low are now watching those same mortgages reset at 7% or higher. Property taxes keep climbing as local governments scramble to cover inflation. And investors, who once propped up prices by buying in bulk, are quietly exiting, leaving everyday homeowners to carry the risk. Even banks are moving faster. The average foreclosure timeline has dropped to just over 600 days, down nearly a quarter from last year, meaning fewer chances for families to catch up or work out a solution. And while national leaders talk about stability, housing counselors across these states are seeing the real story up close. More calls, more late payments, more families juggling between mortgage payments and grocery bills. But here's the thing. This isn't hopeless. If you're a homeowner watching this, there are still ways to stay ahead of the curve. Start with your loan. If it's an adjustable rate mortgage, talk to your lender now, before your payment resets. Build a buffer. Even 3 months of emergency savings can make a difference when prices rise unexpectedly. If you're buying, don't just look at the house. Look at the county's foreclosure map. Some deals are cheap for a reason. And most importantly, don't ignore your insurance. A premium increase of just $500 or $600 a year can turn a manageable mortgage into a financial strain. These aren't just numbers. They're lives in motion. Families trying to hold on to something they've worked years for. Behind every foreclosure filing is a story. A lost job, a missed payment, a storm that hit harder than expected. And the reality is, this isn't just a coastal or rural issue anymore. It's a nationwide affordability reckoning that's slowly finding its way into every zip code. The question now isn't whether another crash is coming. It's how prepared we are to face the quiet, grinding pressure that's already here. Because if there's one lesson in all of this, it's that homeownership in America isn't just about what you can afford to buy. It's about what you can afford to keep.